Welcome to the TrustleBridge Capital monthly video series entitled Know What You Own. I'm your host, Eric Jefferson, and for this month, we're going to focus on long-short equity. Now, before we get started, we have a few quick words from the legal team. With that, we can go ahead and begin. As we typically do, I like to start by defining our topic for today. Long-short equity is one of the most common hedge fund type strategies. That is an investment where you, the investor, owns or is long an attractive stock or index, any investment that has a favorable outlook, while simultaneously selling or being short a lesser attractive instrument. The thought process in doing so is that you're able to profit both from rising prices in those attractive securities that you are long, as well you're able to profit from the decline in prices of those lesser attractive securities. Now, to hopefully help explain this, I want to share a hypothetical example. Now, let's say you had the opportunity to bet on the outcome of future weather. I have two scenarios here. First, we have San Diego, one of the sunniest cities in the United States. On average, it's sunny 275 days a year, about 75% of the time. Conversely, in Hilo, on the wayward side of Hawaii Island, one of the wettest cities in the U.S., given Hawaii's tropical climate, rains on average 290 days a year, or 80% of the time. Now, in this hypothetical example, you have the opportunity to wager $1 a day for the next 100 days. You have your two options there. The first, that it will be sunny in San Diego. The second, that it would be rainy in Hawaii. Now, given the probability of clear skies and rain in those respective regions, that bet, as you can see outlined, works in your favor. If you went with option one, betting that there would be clear skies in San Diego, you'd be right 75 of those 100 days, again, assuming that weathered patterns tracked those long-term averages. Your profit in that scenario would be the $75 that you earn minus the $25 that correspond with the days that it rained, netting you a profit of $50. On a $100 investment, that is a very sizable 50% return. If you went with option two, though, where rain is slightly higher probability in Hawaii, again, assuming those weather patterns tracked long-term averages, you would earn $80 for correctly identifying rain would take place in 80 of those 100 days, less the $20 that were lost on those sunny days would earn you a slightly better profit of $60 or 60%. Now, just like the stock market, weather can be highly unpredictable. And in this case, despite the fact you could earn very attractive returns over longer periods of time based upon those averages, any given year or 100-day period, you would be subject to extreme weather conditions. Take, for example, it was unseasonably sunny across the entire United States, impacting both San Diego and Hawaii. In that scenario, let's say it sunned 100 out of 100 days in San Diego and 60 out of the 100 days in Hawaii, 40 more than it normally would on average. Well, in that scenario, had you invested in sun in San Diego, you would have earned an even better return, earning $100 for correctly identifying sun every single day. However, if you had opted for rain in Hawaii, you see that would actually translate to a $20 loss. Again, using those numbers from above, 40 rainy days minus the 60 sunny translates to that negative event. Same thing in the inverse, should it be incredibly rainy. And given that unexpected changes in macro conditions can meaningfully impact an investor's return in any given year, that lies the beauty behind the long-short strategy. Take in this example, we wagered it would be both sunny in San Diego and rainy in Hawaii. Again, we are betting on those long-term averages, but in that example, if an extremely sunny environment took place, we're going to earn a little more on that San Diego bet, getting 100 out of 100. However, where Hawaii now typically would have been a loss had we picked that option by itself, you can see, although it still translates to that negative $20, that is offset against gains in San Diego. Conversely, if it had been unseasonably rainy, again impacting the entire United States, we opted for both ends of those bets, sun in San Diego, rain in Hawaii. Although the San Diego bet would translate to a $20 loss, we're seeing those losses offset by additional gains in Hawaii, resulting in a $80 gain regardless of macro conditions impacting weather one way or the other. And that in turn captures the benefit of the long short strategy. Take, for example, investing in high quality companies. Those tend to outperform lower quality companies over longer periods of time. However, in any one given year, there's always the threat of uncertain macro conditions, good or bad, that could certainly impact both sets of stocks. Therefore, in this scenario, by being able to offset or hedge against major movements one direction or the other, investors are able to earn a more consistent profit stream regardless of what extreme measures may take place in a given year. So that concludes our session for today. As always, want to thank you for taking the time to tune in, and please have the reminder if there's ever any topics, any positions, any questions you have with respect to your portfolio, please don't ever hesitate to reach out. Thanks again.